Today we're going to go over the benefits and the limitations of the US LLC. We're going to go over why it works, why it doesn't, why it's a grey area, and how the US hides your money. My name is Leo. I've got over half a decade of experience in the field of taxation. I worked for one of the big four accounting firms, and I now help online entrepreneurs all over the world legally reduce their taxes. So, why does it work? Very simple reason is because it has a different payout structure to most companies that allows the exploitation of territorial and remittance basis tax systems. So let's start from the bottom. What do these systems actually mean? So you're probably used to worldwide income for taxation. What does this mean? You're probably from the UK, from Australia, from a country in Europe, from Canada, and you're watching this. You're saying, okay, what does remittance basis or territorial mean? I'll tell you what it's not. Worldwide income. Right? You're probably used to this. Your home country taxes everything you make. If you have income from a business, you're taxed. If you sell a stock for more than you bought it, that's a capital gain. You have to pay taxes on it. Crypto, that's usually treated as a capital gain. In fact, in a lot of countries, they've got very bad regulations for crypto that screw you over big time. Rental income, even if you're from the UK and you have a property in Spain and you rent that property out, the UK will still want to see that property income on that tax return. So this is worldwide income. Everything you make, regardless of where it is taxed. So now these two other systems are a lot more beneficial. So this is worldwide taxation, and this is most countries. Most of the European countries, the legacy countries, you're taxed on all your income. But there's two more beneficial systems, such as the remittance basis, where basically you're only taxed on income that you bring inside of the country, such as Thailand, such as Malta. The UK used to have this non-dom regime. I don't know if you're familiar with it, but basically if you're a resident in the UK but not domiciled, you could be eligible to be taxed only on income that you would bring inside of the UK and not all your income you made worldwide. And then territorial tax basis, which is even better, right? You're only taxed on income made inside of the country, right? So remittance basis is you made it abroad. If you bring it in, you're taxed on it. If you don't bring it in, you're not. Territorial tax system is only if it's sourced within that country. So countries like Malaysia, Paraguay, Panama, these countries have a territorial tax basis. So you'd only be taxed here if, for example, you had like a coffee shop, a local coffee shop in Malaysia selling to Malaysian clients, or if income is sourced from inside the country, right? So if you've got like a place of management, it gets a bit nuanced, but just so you know, territorial tax system, as long as you have an offshore company, most of the times will be fine. This is the difference in the payout structure that you need to understand why the LLC works so well. So when you're a sole trader, you receive all the money yourself, right? Profits come to you, you are the business, you get paid, and you pay income tax based on where you're a resident, right? If you're a UK sole trader, you pay UK taxes, right? If you've got an Australian ABN, you pay Australian taxes. With a normal company, I've put the UK company here as an example, but you know, it can be any company. For a normal company, profits would come down to the company. The company would then pay corporation tax. And then if you want to take out money, you would take out dividend tax, right? So think about it, Tesla, right? Tesla has its own revenue, its own cost. The difference is the profits. And then it's not Elon Musk that pays taxes for Tesla. Right? Tesla pays its own taxes on its own profits, right? For revenue, for selling the cars, costs for like to pay employees to actually manufacture the cars, and then you've got the profits, and then Tesla pays the profits. And then if Elon wants to take out money, he takes out dividends, and now he has to pay taxes personally based on where he's a resident of. Now, the reason the LLC works so well is because you and the company are the same thing for tax purposes. So the money goes straight to the company, right? And that money is already yours. Like, you're entitled to that money. You don't need to pay yourself a salary, and you don't need to pay yourself a dividend. You're paying yourself drawing. So just drawing money out of the company, okay? So basically, legally, you're actually two separate entities, which is great because you can't be sued. You're actually protected. You know, if the company goes bankrupt, you don't. But for tax purposes, you're only taxed once, and you only pay taxes. Where do you pay taxes? Based on where you are a tax resident of. Right? So let's go over it. If you have this LLC in the US, we said the LLC is not taxed at a corporate level, right? This special entity is not taxed at a corporate level. Taxation is like you're a sole trader, so it's not taxed at a corporate level. And then you're taxed personally based on where you have your tax residency. So if it's in the UK, you have to pay UK tax on the profits of the LLC. If you're in Thailand, you have to pay Thai taxes on the profits of the LLC. But Thailand only taxes you on the money that you bring inside of Thailand, right? So as long as you keep all your money outside of Thailand, then you also pay 0% income tax, right? £1,000 comes into the US LLC, it's not taxed because the LLC is not taxed at a corporate level. And then you send that money to yourself personally, not into Thailand, as long as it's not remitted into Thailand, then that money is not taxed. So this is how it kind of works and how you get to pay 0% taxes. But what counts as remitted income? This is very important because a lot of people get this wrong. Thailand only taxes you on the money that you remit into the country. Income remitted, what does that mean? So income brought into a Thai bank account, that's like the way of bringing in money for excellence. You know, this is like the way of bringing money into the country. If you bring money, if you send money into your personal Thai bank account, that's income that's remitted into Thailand. And bear in mind, that is in the same year that you become a tax resident, right? So Thailand recently changed its laws. I'm not going to go into this, but I'll give you an example. If you were living in the UK for the past 5 years, right? And now you move into Thailand, they're not going to make you pay taxes on the income from the previous 5 years because you were a resident somewhere else, right? So that's remitted. Debit and credit card purchases from a bank account with money earned while a tax resident. So what does this mean? If you make a purchase with a debit card and you spend money, spend income that was earned while you were a tax resident in Thailand, then that counts as remitted income. So let's say you offer some videography services, or you've got an agency and you get paid personally, right? You get paid £5,000 into your UK bank account. If you now go and spend that same 5k in Thailand, that counts as remitted income because it's income and it's remitted into Thailand. Obviously, this is assuming that you're a tax resident of Thailand, okay? So that counts. And also asset purchases in Thailand, right? With money earned while a tax resident. Again, like if it's money you had from before, if you worked 10 years in investment banking in London and you have all the money saved up, and now you go and become a tax resident of Thailand and you spend that money that you had from before to buy like property and assets and all this stuff in Thailand, that will not be taxed because you weren't a tax resident before when you earned that money. Like the UK already taxed that income. So if you buy an asset in Thailand though with money that you've earned while you were a resident, that also counts as remitted. But what about in practice? Because, you know, it's Thailand we're talking about. It's still a third world country. You know, some would argue second, but it doesn't matter. So assets purchased in Thailand with money earned while a tax resident. We're online entrepreneurs. We're probably not going to buy anything in Thailand, okay? Or in, you know, whatever, Indonesia, Malaysia, any country with remittance-based system. Debit card purchases. So this is a big gray area. Thailand has nowhere near a solid enough infrastructure for them to tell if it's income that's remitted into Thailand or if it's money they had from before. Like, I'll give you an example. Again, you get paid 5k from your agency services into a personal account, right? You get paid 5k, but you already had like 10k from the year before. So now you got 15k and now you go and spend some money in Thailand, right, through your card. Now, who are they to say that that 5k, that money that you're spending now is the income that you've made from your agency or is money that you had from before? Like, how can they tell? It's so hard. Like, think about it. Like, if you're spending money, the money's all together. You've got one bank account. It's like, how do you even think about this? You know, if you had 10k from the year before, you've made 10k, you've got 20k, and you spend your card, like, what money are you spending? It doesn't matter. Like, it's so hard to understand. So that's something that's not really bothering Thailand, right? As long as you're not spending like these crazy amounts of money, you're probably gonna get away with using your debit card and your credit card to buy stuff from 7-Eleven, you know, or from you know, whatever, your fancy steak restaurant. So the only thing that really counts as remitted income, or not counts, but, you know, it's really enforceable, is income that you bring into a Thai bank account. And this is something that you can control. You can control how much income you bring into a Thai bank account. You open it, you remit like maybe 5k, 10k, and you pay Thai taxes on income remitted, the income that you brought into your Thai bank account, right? Nice and simple. So that's why it works. And another reason why it works, this LLC works really fucking well, is because you can even hide your money. Now, we're not hiding it because we're doing anything dodgy, but can for privacy. So you have your Swedish person with a Swedish bank account. This could be Italy, this could be UK, this could be any country in the West, okay? You have your Swedish bank account and now you decide, I want to open a bank account in Thailand. I'm making a bit of money, but I don't really want Sweden to see all my money, all the money that I'm making. So what happens is I'll put very little money into Sweden and then I'll put all this big chunk of money into Thailand, right, into a Thai bank account. So now you're thinking, if I have to pay taxes in Sweden, I'll just keep my money in Thailand where they can't see it, right? And I'll only declare the income that I've made in Sweden. So this is why it doesn't work, because of this thing called CRS, Common Reporting Standards. What happens is now, Thailand, when you register for a bank account in Thailand, Thailand will ask you, where do you pay your taxes? And you are going to have to tell them your tax number. And that tax number is going to be in Sweden. So what happens now, Thailand has the Swedish tax number, and now they have to go to the Swedish tax agency and tell them, hey, there's this Swedish guy that has this bank account in Thailand with all this money. Make sure he's declaring all that income, right? This is CRS. This is, we're digressing a little from the LLC, but this is what happens. Now, the US is one of the few countries alongside Vietnam, Bolivia, Armenia, these countries with like very bad banking that doesn't actually report to tax agencies. And this is insane. Think about it. You can have a US bank account, that's a company bank account, fine, right? That doesn't report the income to your home country. Any other country in the world, most countries, if you have a company in Australia, in the UK, you've got all the names of the directors on the register in the UK. It's absolutely crazy. The US is one of the only country, or at least the most advanced country, that still does not report tax information. So you can open your company from anywhere in the world and no one will know that you own this money. And that's crazy. That's crazy. You can earn it, you can spend it. I don't recommend you use it for personal lifestyle, but technically if you really wanted to, no one could really tell. So now, what are the limits? Because it's not all fun and games. There are limits and it doesn't work in certain aspects. So the first risk is the money laundering risk, and the second risk is how it can impact the tax residency judgment. So money laundering risk, you send your money, you got your US business, you got your LLC, the profits go to your US company, and now you want to take the money out, right? Before even questioning tax evasion, the UK bank or the Swedish bank or the Australian bank, whatever, is going to question money laundering, right? Because the UK doesn't see the US company. Now you're sending all this money to the UK and they're like, okay, where's this money coming from? Danger, right? Because they don't see the activity. They're thinking money laundering. They're thinking, where's this money coming from? Obviously over certain amounts, right? We're talking about like $500,000. Probably if you send like 100K a year, that's like what, 8K a month. Nothing's really going to happen. You're not really going to be questioned, but money's coming in from this weird source. They don't know you own the company, by the way. So the first thing they're going to ask you, they're going to make sure it's not like money from, money that's been laundered with like weapons, right? Or drugs. So they'll ask you for your receipts. It's like, show me that these are legit business activities that you've done to earn this money. That's the first thing they're going to ask. And if you've got Stripe, obviously super easy. You show them the Stripe receipts. They automatically send invoices when you send Stripe payment links. If you take bank transfers, make sure you're issuing receipts and you keep them because they're going to ask them to you. The second is it can impact your tax residency judgment. So let's say you have moved to one of these territorial tax countries like Paraguay, like Indonesia, or maybe remittance bases such as Thailand, Malta. What happens is it can impact your tax residency judgment. So what does this mean? The problem comes when you want to make personal purchases, because as long as this money stays inside the company, it's not really an issue. As we said, they can't see it. If you make $10 million and you spend $10 million, no one really knows, and as long as you're not buying assets, and stuff in your name where it becomes more complicated, they probably won't even let you buy big assets in your name. If you're using like someone else's card, you're probably going to have to use your own card. They want to see like that it's actually your bank. But big assets aside, you're making 10 million, you're spending 10 million, that's fine. The problem arises when you want to make personal purchases, and that is because you're going to have to send it to a personal bank account. You're going to have to send it to a personal bank account because most of the times you're not going to be able to make purchases directly from the US company. right? And if you're living in Thailand and you're trying to make use of this remittance basis system, where basically all the money that's brought into a Thai bank account is taxed, well, you are going to want to not send that money to a Thai bank account, because otherwise that's all money that's taxed. So for example, if you're an Australian and you're making quite a bit of money and you're sending that money to Australia, Australia might go, hey, like, you told us you're living in Thailand and you're paying your taxes in Thailand. Why is all this money coming here? And Australia, as you probably know, has very broad rules for tax residency. Like, they say, yes, if you spend 6 months in Australia, you have to pay taxes here. But if you don't spend 6 months, then it's like, where's your center of economic interest? You know, where's your family? Where do you usually live? All these like broad questions. And they make it broad on purpose so that if you're making a lot of money, they can actually catch you inside of their net, if that makes sense. It's like you're sending $500,000, for example, $500,000 to your personal Australian account, and you're not sending it into Thailand, because if you send it into Thailand, that money's taxed, right? That's the rule. Remittance basis. If you remit it to Thailand, that's taxed. If you send it to like Singapore, if you send it to Hong Kong, you know, that's not an issue. If you send it to Switzerland, but they won't take you on for personal accounts unless you're like a millionaire. So until you do become a millionaire, you're probably going to keep your money into a personal Australian bank account, New Zealand bank account. And this can impact your tax residency judgment, because they can come to you and say, hey, we think that there's a lot of economic activity here. This is a Thai that they can come and get you for. The third one is a permanent establishment, and this is, again, quite a complicated one. Its risk is a lot higher in Europe than it is in Southeast Asia, I will say this. But basically, permanent establishment is when you have a fixed place of business in a certain country. And what happens is, if they deem that you have a permanent establishment, you know, this fixed place of business in a country, then they would tax that permanent establishment, right, based on the profits that it has earned. So I'll give you an example. If you have a massive retail shop in Italy and you're selling, you know, perfumes, you now open up a little location in Spain, but you still sell under the Italian company's name. What's going to happen is Spain will go, actually, there's this permanent establishment, there's this shop that's making some money from your company. This portion of the income that you're making is actually taxable in Spain. This is what's going to happen. Obviously, for us online entrepreneurs, we don't really have the problems of shop, factory, you know, employees on payroll. You know, that's not issues that we have. The catch is, one of the criteria for establishing a fixed place of business is actually a place of management. Right? And unfortunately, it doesn't need to be an office, it doesn't need to be a house. If we are the only owner of the company, we can create a place of management just because we're the only shareholder, and we can create it literally anywhere in the world by just being somewhere and making the decisions. So it's something we need to be very careful about. And the problem is, if they actually say that, hey, we have a permanent establishment, like, give you an example, if you have a US company and you live in Thailand, Thailand may go, and again, it's not happened, not that I know of, right? It's happened in Europe, where people, for example, in Italy, would run US LLCs, and Italy would say, hey, like, this company is actually run in Italy, so we're going to tax this company as an Italian company. Even if you don't have offices, even if you're selling online, if you're the only shareholder and you're making the decisions in Italy, then this company is going to be an Italian company, and it's going to create a permanent establishment in Italy. So this is all going to be taxed in Italy. But corporate, right? Because Italy doesn't see the US company in the same way as the US does. So they'll see it as an actual company, they'll tax it at a corporate level, and then they'll tax you personally again. So it becomes a huge mess, and then you're going to get fines as well. So this is a big limit. Obviously, it's less likely this happens in Southeast Asia. They still have rules like Thailand, Indonesia. They still have these permanent establishment rules, but it's a lot hard for them to enforce. Like, it's more likely they'll enforce it if you actually have a physical office. Like, if you're just living on Airbnbs, you know, it's probably not going to happen. But again, taxes are very behind, we're very ahead of our time, you could say, or taxes are behind our time. Online work, if you think about it, only really started booming after COVID. Like, yes, you had the first pioneers of Facebook ads back in 2015 or 14, but you know, online work only started recently, so they're still catching up with us. So this is, again, probably not going to happen if you're making 200, 300k. But again, the more money you make, the more you need to make your case airtight, and the more you're actually at risk of all this stuff. So again, recap why it works, because it's not breaking any laws or rules, and it's legit. It's a legit way of doing business. No one knows about this company or the money you have in there. That's a big plus. Again, you're not breaking any laws, and if you're on the gray area and no one knows about it, then you're going to get away with it. As long as no one gets in your way and questions your tax returns, you're going to be fine. You can do whatever you want with taxation as a business owner. And it works because it's got good banking options. Like, you're banking in the US, like at a certain point you can even get an Amex, and it's a well-known structure. A lot of people use it and it works. They might patch it, who knows, but for the time being it works quite well. Now, why doesn't it work? It's a gray area. Like, you're not supposed to not pay taxes. Like, all these double taxation agreements are made so that you don't pay taxes twice. But like, you're supposed to pay taxes somewhere, okay? So this is a big gray, like, unless you live in Dubai or like in the St. Kitts, this is a loophole. This is a gray area, It's like, it's not breaking any laws, but it's also something that, it's probably going to get patched sometime soon, I assume in the next maybe 2-3 years. It doesn't work because when you're taking a lot of money out of the company, you get the risk of getting caught in the home country's tax net. So again, if you're Australian and you're taking over $500,000 USD into your personal account, Australia may go, hey, you told us you were resident in this country, why is all this money coming into here? And they can argue that you're still a resident in that country and they'll tax you on all the income there. And again, you still have the risk of permanent establishment, blah, blah, blah. And then again, you have the risk of permanent establishment. Like, if they tell you that you are resident in Australia now, they can say that the company's managing Australia, and it just becomes like a huge mess, especially in Europe, Australia, and the UK. So I would say it works if you're starting out up to $500,000. Assuming you've moved your residency and you're living somewhere like Thailand, Malaysia, Indonesia. If you're living in South America, it's something that works. If you're living in Europe, do not set up an LLC unless you have clients in the US, and even then, put something around it. Over $500,000, once you start taking out over $500,000 in personal money to your personal bank accounts, that's when I would consider holding structure. And putting something on top of this US company, so at least you are not the owner. You separate ownership from control, and that's how all the big boys make their money and set up their businesses. So yeah, thanks for watching, and let me know if you have any questions about the LLC, and let me know if there's any other topic that you'd like me to cover. Bye bye.